Welcome to this recording on the joint report published by the European Central Bank and by the European Systemic Risk Board on climate-related risk and financial stability, which was earlier announced this month by the ESRB chair and the ESB President Madame Lagarde to the European Parliament. Today, I have the pleasure of virtually connecting with three officials from the European Central Bank who have been directly involved in the drafting of this captivating report. Paul Hiebert, Head of Systemic Risk and Financial Institutions Division, Stephan Fahr, Team Lead in the Systemic Risk and Financial Institutions Division, and Katarzyna Budnik, Advisor at the ECB focusing on stress test modeling. In terms of their contribution to the report, Paul Hiebert co-led the project team taking care of the report. Stephan Fahr led the risk monitoring, so measurement workstream, and Katarzyna Budnik led the risk assessment, this is scenarios workstream. In June 2020, the previous ECB-ESRB report, Positively Green, Measuring Climate Change Risks to Financial Stability, was the first step in the analysis of climate-related drivers to financial risk in the European Union. This report, published in July 2021, in turn, aims to examine how climate change affects financial stability, bringing new insights on physical risk, deepening insights on the financial impacts of transition risk, and exploiting a growing number of modeling initiatives in the European Union. So Paul, in terms of how it was decided what to include in your analysis, perhaps you could start by describing the coverage, scope, and databases of the report and explain the rationale behind each of these three features of this report.
Thanks, Maria, and thanks for the opportunity to share with you our findings today. I think there's quite a bit in there, and we're going to try and pack as much as we can into this interview. But of course, there's a lot online available in reports, which is published along with a data supplement, which I think is quite a useful reference for the work we've been doing on climate. And maybe to get back to your point about the scope and the like, I think what's probably good is to just give you a bit about the path of how we got there. So we established a group with the ECB and the European Systemic Risk Board. And for those of you who are not familiar with the European Systemic Risk Board, it brings together all relevant authorities in Europe that are responsible for systemic risk. So that is from the ECB side, the national supervisors, but also to the side of the European supervisory agencies like the European Banking Authority, the Markets Authority, the Insurance and Occupational Pensions Authority. And that gives us a nice system-wide perspective. So what we really did as a starting point, and as a sort of mandate we had as an overarching aim, is to be sure to add some positive measurement into otherwise what is quite a normative debate. Normative in a sense that pretty much anyone you talk to has a view about climate and its risks and its potential, what its policy options, other elements we should take. So we shied away a bit from this initially, and what we wanted to do is pick up information, measurement, leveraging our membership to have proprietary data, the ability to leverage also multiple initiatives, bring them under one umbrella. And that's basically what we want to share with you today, some advances. Now, by way of background, I told you about the path about how we get here. So last year we had a first report. And that report is listed on this slide here, was really just about trying to see with existing data, existing models, what could we pick up about climate and how can we refine the questions we need to ask with the idea that we tend to have data for financial economic purposes, not specifically for climate analysis historically. But in fact, we did find you can do a lot of retooling, but it does require some sort of more investments in particular areas. And I think two came out in particular when I go to this building on needs for further work, which was better data and new investments in modeling, data on the side of particularly climate data and mapping these data back to economic and financial metrics, which tend to be in our purview, and modeling really from the perspective of these are multi-decade horizon issues we're dealing with, not the standard 2, 3, 4, 5 year horizon we tend to have for other economic or financial purposes. Now, what I can do is maybe just roll forward a slide and just mention in a brief word, this is how the team was organized. But again, the idea was we were having a particular idea about a measurement focus here. And that measurement focus meant that we had two work streams. One was really about the idea of getting a grasp on risk monitoring. How do we understand where the risks might be emerging? Again, the overall financial system, not just banks. We're looking also at non-banking financial institutions as well. And then thinking about that mapping to climate, also then from the perspective of assessment here in a sense of scenario analysis, forward-looking modeling, system-wide type of efforts as much as we can. Where we cannot interact, at least we should look at each block in turn. So with that in mind, we basically had, coming back to your question, I think, which is a relevant one, is the three things which I think are pretty key in outlining what we were intending to do in this report. And I think you'll find quite a rich content in the report itself, was coverage, scope, and data. Let me speak very, very quickly about each. So coverage was really this idea within climate. For those of you familiar with the topic, transition risk has various scopes of emission. What you actually emit when you produce something, a good, what you have in terms of inputs, and what you have in terms of downstream use when it gets into the economy. And that downstream use is very poorly estimated. And what we found last year is it's very hard to obtain estimates. This year, we've managed to try and get some estimates working with private data providers of so-called scope 3 emissions, these downstream emissions intensities. The other one was physical risk, which, as central banks and supervisors, we had tended historically not to look at in that much detail, but is actually quite important, of course, for the world of climate, as climate hazards as such. And I'll come in a slide to that in a minute. So I mentioned the idea of physical risk, capturing this more accurately in a financial angle, and transition risk, the full scope of emissions. Scope, of course, was about the idea of banks to non-bank financial intermediaries. I've talked about that already. So the entire financial system, not just a narrow look, but a more financial stability macro look. And lastly, on data, was we were basically trying to get the proprietary data we have at hand here, supervisory data collections, confidential information, and mapping that in a very detailed way, in a very granular way, back to elements of economic meaning and also financial exposures as such. And the whole idea behind this, again, is that climate change will impact those parts of the financial system most exposed to its disruptive effects. And it's important to get a grasp on these. Now, just before passing over to your next question, I would just quickly mention, maybe as an illustration, the difficulty we faced, if I skip forward a slide here on the physical risk modeling, is the idea that you have to get in climate risk monitoring from the side of climate science, mapping, over to financial risk. And there's basically 4 steps we have in this process. So initially, the bottom step, and as you see, they're being built up here, is obtaining maps. So maps of detailed maps, not just at the region level, but sometimes with climate things like flood questions, wildfires, you might have a different impression about how many square meters you actually want, or square kilometers you want to cover. So flood is a very localized event often, and we've seen, unfortunately, that manifest itself already this year in Europe and elsewhere. And that idea is that you really need granular mapping, which are mainly address level, not just region level. And that's been our challenge, is to pick up these maps. And again, working with private data providers, we managed to make some inroads here. The second layer up is about hazards. So climate physical risk can come in 4 different varieties: hydrological, climate-related questions, geological, or meteorological. And you'll see those in the presentation as we go along. The third level is, of course, it's a question of, now I've got the climate risk and I've mapped that. What is the economic function of the firms in particular which are impacted by this? What is the actual physical risk associated economic-wise with that particular climate hazard in that region? And then lastly is this idea of pulling out the aggregate impacts. And that's trying to understand productive losses that could occur. So for the exposures of financial institutions, again, from climate to economic to financial exposures, and thinking about elements of mitigants, which might be there to also protect in the case of gross to net exposures. So in a long-winded way, I think I've hopefully come around to the idea of what our intention was. I think perhaps now we can shift back to you and maybe shift more into the results, which I think are quite rich and interesting.
Thank you so much, Paul, for this starting explanation on how the report was organized. And I'll perhaps take this occasion to shift to a more specific question to Stephan and understand how the granular mapping of financial exposures to climate change drivers that were included in this report and found 3 forms of risk concentration, how this can be better explained to our listeners.
Yes, thank you, Maria. Indeed, as Paul just indicated, the multiple granular data sets have been crucial for the analysis in the report. And we drew from the insights from the various, combining these different data sets together, and found an uneven vulnerability to climate risk across the regions, sectors, but also individual firms. So it is important to be aware of this concentration of risk along those 3 dimensions, so as to devise policy responses that are both targeted and effective. But let me elaborate on this along the 3 dimensions of concentration in relative terms. So the first concentration dimension is the one of the regions or the geography. So here, what you see is that on the left, you see the map of Europe and of the European Union and the distribution of individual firms. Now, this is based on the commercial data set that Paul already mentioned and covers 80% of firms once we combine it also with the European credit registry called AnaCredit. And it shows the maximum exposure of individual firms at their headquarters or at the location of their main facilities across the different physical risks. Those cover floods, wildfires, hurricanes, heat stress, water stress, and the color of the dots indicates the relative height intensity of those risks. What we can see is that there is a clear geographical concentration, whereby floods are most relevant in central and northern areas of Europe, with more than 7% of individual firms facing high or increasing levels of flood risk. Heat-related hazards dominated southern Europe, with 18% of firms exposed to heat stress, water stress, or wildfires. This information combines both historical information, but also projections over the next 30 years. So looking across the individual hazards shows the distributions across countries, where we have the Mediterranean countries clearly under threat of heat-related risk, and other countries of these water-related risks. But the regional concentration is only one of the three dimensions, and the concentration also extends to other forms. And here we can aggregate our granular data also to the sectoral level. On the left, we see the distribution of loan exposures across sectors. That's the first column that we see, and emissions, which are columns 2 to 4. Speaking about the first one, while manufacturing, real estate, wholesale, and retail trade are the largest sectors in terms of loan exposures of banks, this differs for scope 1, 2, and 3 emissions captured by the subsequent columns. So for scope 1 emissions, which are the direct emissions in the chart, firms like in the mining and energy sectors in blue and red are those that are most carbon intensive sectors. But they only account for about 5% of banks' loan exposures and may therefore have more limited role for financial stability purposes. In turn, the manufacturing sector in yellow dominates the indirect scope 3 emissions, the before last column, which account for also for downstream emissions. As a result, transition risk may actually be also subject to preference changes, consumer preference changes, changes in demand, and may therefore affect also the manufacturing sector, which has a larger use of loans from banks. Now, looking beyond banks, and looking at investment funds, insurance companies, and pension funds, they hold around, on the right, they hold around 30% of their portfolio in securities of high emitting NFCs. And that is mainly in industrial, energy, and material sectors. So this is the blue area in the right-hand panel, which a lot drives into those three sectors. Just as a side remark, the share of 30% has been relatively stable over the last years, since 2013, but the nominal exposure of securities has doubled to combine 1.6 trillion, also due to the shift that has taken place from banking to non-banking intermediation. Now, this was the second dimension of the concentration. Let me get to the last one, the firms, the individual firms one, where the granular data is actually vital. So we spoke about the sectoral concentration, and here what we see is scope 1, 2, and 3 emissions relative to their revenues of individual firms, and we show the median, the 25th and the 75th percentiles, and the minimum and maximum within each sector. Now, we already established that there are some sectors that have on average higher emissions, and the electricity sector here is clearly has a higher median here. But at the same time, this sector has also a huge variation within that sector. So we need to be sure that we capture this variation so as to design policy and responses that are, as I said, targeted and effective. Now, and we kind of ensure that go and develop also metrics going forward, which ensure that we capture those firms with low emissions and differently from those with high emissions. So wrapping up on the concentration, the report clearly indicates concentration in certain regions, in certain sectors, but also with certain firms within sectors. And we think that this is important groundwork that serves as future input for policy work. Thank you.
Thank you so much for elaborating on these three dimensions of the risk concentration. I'll perhaps suggest that now we take again a broader perspective on the report and would ask you to please share the key findings found by the risk monitoring workstream.
Yes, thanks, Maria. And here I'd like to kind of start out with additional findings we had with a physical risk exposure of banks, which you see here on this chart. No? So the around on the left, we have the exposure of banks via firms to the 6 hazards that we considered. And in the last column on the left, we have the probability of or the share of exposures to any hazard. Now, what we can see in that last column is that 30% of bank exposures, of loan exposures by banks, are to firms in areas with at least one high physical risk driver. High, or we call it also the increasing exposure from already high levels. So this is quite an important share. And we need to have a bit more analysis to assess how losses for the financial sector can be mitigated going forward, and I'll turn to that in a second. And also, we need to understand how adaptation measures are taken, and either by firms or by governments in order to mitigate those potential losses. Now, on the right, you see a distribution by country, and some countries are strongly exposed, or exposures in some countries are extremely high, and with some firms having multiple hazards, are facing multiple hazards, not just one. You see that some of those high exposure countries are obviously the larger ones, but there are also some which are not fully aligned with their either geographic size or with their economic activity, and may have therefore stronger risk concentration in those areas. Now, another area digging a bit deeper into the banking system, what we also did is we looked at how are the exposures of banks distributed among the banks themselves. And we distinguished on the left both the banks, or grouped them into their quartiles, either by CET1 capital ratios or by the return on equity quartiles. And what we find for both dimensions is that kind of more vulnerable banks or less capitalized banks are exposed to larger amounts of physical risk. This is also true for the return on equity. Hence, already weaker banks today face potentially additional risk going forward through the physical risk dimension. Now, going into individual banks, what you see on the right-hand side is the 25 banks that have the largest exposures to the NFC, to the corporate sector. And 10 banks hold individually more than 3% of the total exposures of high-risk firms. So this is captured by the blue bars. And when we aggregate those blue bars, we see that the 25 banks with most exposures hold around 70% of the banking sector credit exposures to these higher risk firms. And finally, just to complete on those red dots there, 7 of the 25 banks have exposures of 10 to 15% of their total assets. So they have quite some exposure to these firms. At the same time, these banks, when looking which ones they are generally larger and better diversified today. Nevertheless, this is something to be monitored over time, how it will be evolving. And I mentioned before mitigation measures for the banking system. Now, one obvious mitigation measure is collateral itself. So collateral can be used in order to absorb losses, but at the same time, if it is subject, physical collateral, especially if it's subject to physical risk, may not be as effective in mitigating those losses. And here on the left, we see clearly that some sectors, most of all the real estate sector, may be subject to those additional physical risks. And for the real estate sector, the physical collateral in red, yellow bar is obviously an important one. At the same time, another mitigant is obviously insurance. And what we see is on the right is from our colleagues from EIOPA, is an analysis about the protection gap for European countries. And they did so for individual countries and across individual hazards. So what is the issue here is as physical risks materialize or intensify, there may be risks that the insurance companies may no longer be able to insure those risks going forward. This has repercussions for the sovereign and needs to be obviously monitored and may lead to a market failure down the road. So this initial assessment of this protection gap has been kind of very valuable, but here as well, as Paul mentioned at the very beginning, more data is needed, more granular data is needed, and EIOPA especially is in contact with the insurance companies to develop that. Another part, going beyond banks and insurance and more to financial markets and investment funds, we have seen kind of a very strong growth in financial markets and in the issuance, in the financing, green financing, and more generally, ESG funds, so economic, social, and governance funds, have been growing strongly. To be specific, have tripled since 2015. Green bonds have increased 8-fold, and catastrophe bonds doubled. Last element, the emission derivatives, has even increased 7-fold from very low levels. This last part, the emission derivatives, already indicates to us that the financial markets are picking up on hedging through financial instruments, the risk of that is related to emissions. And on the right-hand side, you see kind of nicely the share of the portfolio in green versus brown firms within the investment fund sector. And here it is clear that there remains the bulk of the investment fund sector is of the exposures is still to relatively brown or high emitting firms, and this will be kind of a challenge to adjust this exposure over time and to hedge those risks and mitigate those risks going forward. Finally, just to wrap up on one instrument that, or a market mechanism that we think has become very important over the last few years, is actually the emissions allowances and the trading that has taken place there. This is important because it redistributes the risk with regards to emissions. And since 2018, as you can see, has been increasing. The price of those allowances has been increasing strongly and has become more information sensitive. Hence, it is an appropriate mechanism to react, for the market to react and hedge against those risks. Finally, on the right-hand side, just to indicate that there has been a strong pickup on exchange traded commodity derivatives for CO2, while for oil, coal, and gas, these have been declining. I think that's kind of a nice overview of those elements that we have covered in the report. as indicated earlier, across the banking sector, insurance, and the financial markets, including investment funds. And by this, I give back to Maria.
Thank you so much, Stephan, for sharing the key findings regarding physical risk, transition risk, and also the role of collateral and insurance provision. It is mesmerizing to listen to what the risk monitoring workstream has concluded. So perhaps shifting now to Katarzyna, who has led the risk assessment workstream, I would like to start by asking you, what can you tell us about the stress testing initiatives that have been conducted so far? And if possible, I would also like to ask you to please highlight the key features of the stress test methodologies that were used.
Thank you for the question. If we move to the next slide, we will see a good overview of where we stand in terms of stress test initiatives around Europe. So the bars here, and especially the length of the bars here, signify the date where certain initiative is published or made available. So looking from at the left-hand side panel, for example, we see, and making a cutoff point around 2018, so to say, so quite a few years ago, we see that there were very few already known published initiatives in terms of stress testing for climate risks. But if we look at this thick line somewhere in the middle of the panel, this is where we stand today. And one observation is that there is a huge concentration of stress tests of forward-looking scenario analysis, which are published around this year or a bit after. This definitely signifies increased interest and increased concern that this type of forward-looking assessments of climate-related risks is relevant. When we looked at those initiatives a bit more in detail, we spotted certain commonalities, and those commonalities also inform the analysis which we in the end run in the report. So first thing is that whereas the first initiatives were very much focused on stress testing for transition risks, there is an increasing interest and increased ambition to make future initiatives also cover physical risks. The other thing which closely corresponds or interrelates with the former is the extending horizon of the analysis. So let's say the first initiative run by Dutch Central Bank back in 2018 covered the horizon of 5 years. Now we get much more ambitious with horizons varying between 30 years or even longer. And this very strongly is coupled very strongly with increased availability of this type of long-term scenarios, definitely fostered by NGFS scenarios. Another observation, and this more better illustrated on the right-hand side panel, is that a predominance of exercises which are run in a top-down fashion and potentially include also macro-financial elements. What I mean by here is that these are still exercises which are done in a centralized way by central banks or supervisory authorities, rather than initiatives which directly involve financial institutions. And last but not least, which might sound like a refrain of our joint presentation, there is a significant move toward use of much more granular information, much more granular data in any of those analyses. And I will touch two more of those 4 points in the next few slides. So a few more words about long-term scenarios and NGFS scenarios, especially already turning to the second part of your question, how we tailor our own analysis. So these are 3 exemplary scenarios which we picked up from the family of scenarios provided by NGFS, on which we leverage in the report. And this also gives us a feeling of how those scenarios are built and why those scenarios will be well tailored to marry both transition and physical risks. So orderly scenario is a good scenario. In this scenario, we managed to meet Paris target of limiting the global warming to less than 2 degrees Celsius within the next century. This is a scenario in which we are very effective in limiting emissions. And you can see, for example, like this dropping emission with a red line in the left-hand side, and the temperatures which remain contained in the middle chart below. In a disorderly scenario, this is a scenario in which there is a lacking recognition of climate problems initially, so the policy action aiming at limiting emissions comes late. It allows us to still meet Paris targets, so we are still successful in containing increase in temperatures. However, this comes at the higher GDP costs, which is signified in the last chart on the right-hand side, then would be the case in the orderly scenario. And in the last scenario, we call it the hothouse world. This is a scenario in which we have missing policy action. So resultantly, we do not meet Paris targets. Resultantly, we do have concentration risks toward the end of the horizon. And we will focus in our report on the next 30 years in reflecting each of those scenarios looking forward. But already here you see that disorderly scenario will very much emphasize transition risks, whereas hothouse world scenario allows us also to look a bit deeper into physical risks. And a few more words about what I mean by the increasing use and promising avenues, which is the use of granular data, in a few next slides. So this one illustrates, let's say, where we stood still 2 years ago in terms of methodologies. And on the right-hand side of the slide, you can see where we stand now. So 2 years ago, we were still in the world in which we were taking a macro financial scenario, as illustrated in the previous slide. We were trying to break it down or to describe sector level developments on this basis. Then we were trying to map these sector level scenarios directly into bank level or insurance level parameters or developments. And resultantly, we are deriving the impact assessment of financial institutions. Now the picture looks much more blurred, but is also much more promising. So it was still in the first slide. If we could move back, Stephan. Yep, we are starting with the same macro financial scenario, but we sometimes break it down into sector level scenarios. But the intermediate step before we get down to financial institutions is this use of firm level balance sheets. And these firm level balance sheets offer us lots of opportunities to account for this diverse distributions of risks across firms within the same sector, which Stephan already emphasized. It allows us to factor in lots of information which is available on firm level, like technology improvements, emission permissions. And only via this step, we'll go to firm level PDs, for example, so probabilities of default, and map it in the financial situation of financial intermediaries. And moving back to the slide which Stephan already previewed, this illustrates the power of this approach. So here we track the potential probability of default as modeled based on a very detailed data on exposures of banks to different sectors. And we use it to see at the evolution of those probabilities of default for low carbon industries, and marked always on the left-hand side, and high carbon industries on the right-hand side. In the orderly scenario, so in the good scenario and disorderly scenarios from NGFS. And we see one thing to start with, that low carbon industries have low probability of default than high carbon industry. But what is more interesting is that the longer the horizon, the larger the gap becomes, and this gap becomes even more pronounced. So there is this unproportionately high increase of risks to quality of assets in the disorderly scenario in high carbon industry. Same message at different parameters and a different data set in the next slide. So in this case, we use detailed loan level information, and we do the same trick. We try to use this information to model another credit risk parameters, loss given default. Same message. Low carbon industries will experience some increase of risk, mostly in disorderly scenario, marked by this additional yellow cap, but this increase in risk is proportionally higher in high carbon industries. And last but not least, an example of the use of the same granular approach in upcoming ECB top-down stress test. On the left-hand side, a breakdown across industries, but I would like to more emphasize the right-hand side, where we see the evolution again of probability of default in the disorderly scenario and in the hothouse world over time, and again broken down in let's say exposed firms or less exposed firms. So there is this clear increase in risk in disorderly scenario marked by blue line in the second part of the horizon, but a very sharp rebound of risks and consequently much higher level of those risks at the end of the horizon for the hothouse world.
Thank you, Katarzyna. By reading the report, but also based on what you briefly mentioned in your earlier response, I understand that you have advanced some forward-looking assessments of financial losses that surely contribute to advance the broadening climate debate. Would you like to describe what you concluded in this regard, in particular regarding credit risk and market risk?
With pleasure. So this brings me to the next slide. And let me kind of say a few words. Where did we get with this new granular data? Where did we get with all the thinking about the scenarios? So one of our ambitions in the report was to use NGFS scenarios in a possibly consistent way to do a first such coordinated exercise in Europe across all three pillars of the financial sector. So we plugged this forward-looking scenario analysis into a banking sector, into insurance sector, and into investment fund sector, each time involving the relevant authorities, so European Banking Authority, ESMA, and the EIOPA correspondingly. Each time we use disorderly scenario, and here we deviated a bit in terms of what each methodologies available in-house allowed for different sectors. So hothouse world was possible to be run only for the banking sector, but for insurance and investment sector, we were also able to look at the difference between disorderly and the baseline scenario. We used in each case a very detailed information about balance sheets of all three institutions. And coming more precisely to your questions, we focused on the credit risk for the banking sector, where while we were looking at revaluation losses, so the market risk for insurance and investment sector. And interestingly, the messages are very consistent across sectors. For the banking sector, what we find in the next slide, giving us the preview, is first of all, relatively modest, and I will come back to it a bit later, modest increase in overall losses this is like a 1.6% on the relevant exposures to large corporates, which is marked also by the blue bar in the left-hand side chart. But what is interesting in this case is maybe not the overall magnitude of the losses, but when we break these losses down into the contributions of particular exposures to sectors of banks. And this will be a repetitive pattern across all the charts now. So the largest contributions for the banks comes from electricity. So high carbon intense industries and real estate exposures, which are also following the definition applied here, will be pretty high in emissions. On the right-hand side, we see the same exercise done for hothouse world. Again, losses are here higher. So this is this interesting discrepancy which we've seen already in probabilities of default in one of the previous slides. But the same message comes across, that of concentration of risk of certain economic sectors, and these sectors will drag down the overall outcomes for the banking sector. If we move for market losses in the next slide, here we have in one slide market losses for insurance on the left-hand side and for investments on the right-hand side. Absolute losses are again in the blue bar, and they are modest. However, and again, there is this concentration in oil production, gas production, and for investment funds in energy and production of basic materials, highly carbon intense industries. So in a sense, forward-looking analysis repeats the main messages which were already raised by Stephan. Financial sector is exposed to risks, to climate-related risks. This exposure to risks is very much concentrated in a few relevant portfolios, and this is what would be one of the let's say main findings and or repetitive findings in the forward-looking analysis.
Thank you so much for guiding us through the climate scenario analysis in the banking sector, but also beyond the banking sector. Perhaps as a last question for you, and very briefly, how would you summarize the key findings found by the risk assessment workstream?
Not repeating myself, so one would be, of course, this concentration of risks, but there, like I would say that there are like three main takeaways from what we have found. So one thing is that granular information is not only helpful in mapping the risks, but granular information is also extremely powerful tool for a powerful intermediary for arriving at good models which allow us in turn to forecast climate-related risk forward. So the same messages which were already raised by Stephan can be only repeated in this context. Second takeaway is that analyzing climate scenarios for stress testers is a new kid on the block. And I was mentioning it already that some of the losses which we find are relatively contained to what we find in normal scenarios. And this hides a mess, like this hides the truth also about those scenarios. What we as stress testers are used to is a very strong concentration of risks in a very short time horizons. A typical stress test is 3 years of a deep dive recessions across the economy. Climate risks will be realized or will be spread across very long horizons. And some of our thinking about how to capture those risks or how to model those risks have to be revised so that we are better at illustrating them all along with the relevance. And a related third takeaway would be for me that if we run this type of exercises with very long scenarios, what becomes very relevant is to also model and account for the reactions of both the industries to climate-related risks and the financial institutions. Our standard assumption in stress testing would be that all the exposures remain constant, so-called constant balance sheet assumption. Whereas this in the long horizons, this becomes, first of all, not very realistic. And secondly, we might miss a relevant part of the true story.
So thank you so much, Katarzyna, also for sharing these final remarks. And Before wrapping up today's recording, perhaps I'll ask Paul if there are any concluding remarks that you would like to add, and also what are the next steps to fill the existing gaps in climate-related risks.
Thanks, Maria. And I wouldn't want to repeat too much what Stephan and Katarzyna shared. And of course, with their work streams, it's very much a collective effort. They managed to pick up, I think, a lot of dedicated hard work to make this very granular data mapping and very big horizon extension happen. I guess the two big things to highlight before I get to, I think, let me talk about what we could do. And as we go along with this incremental approach we've been taking so far, every year, publishing what we learn, trying to share this, and trying to share insights or findings, and also our more refined questions, I can maybe tell you what we learned and what we still think needs to be done. So what we learned, a couple of things. I think in terms of the financial stability outlook, you'd be very concerned remembering the financial stability definition as a cross-sectional in a time series component. Then in a cross-section, there's this idea Stephan mentioned. Sectors are problematic, some of them in terms of emissions exposures more than others. Geographies are important when it comes to physical risk hazards. Some of them are quite susceptible compared to others, both on a gross basis and also net of mitigants, which themselves might not be necessarily there under systemic stress. But I think one of the biggest insights there, as Stephan had shared at the end of his presentation, was the idea that within sectors there's a huge amount of heterogeneity. And that heterogeneity, I think, is quite important because it means you can have very efficient firms and very inefficient firms in the same industry, meaning that we can move that technological frontier forward in a greener manner. It might actually do a lot of heavy lifting. The other point, apart from the cross-sectional, of course, is the time series. And Katarzyna's work, I think, was crucial in understanding a bit more about the path dependence of risks. So this idea of the transition physical risks are not independent, they largely interact. And of course, the more transition you take now, the less physical risk manifestation you'll have in the future. And I think that element has, of course, distributional impacts as well as aggregate impacts. And she covered some of the sectoral impacts there too. So I think those insights to me are pretty important. I think they're helping bring this debate forward. Of course, whilst we have those insights, and this is perhaps when I come back to the last point here, is there's still quite a bit of unfinished business. We've made progress, but we still think a lot remains to be done. Let me just distill it into two different categories. So first is this idea about measurement. We still feel measurement in terms of the sufficiency of reported information and its quality is still mixed at best and sometimes lacking. So we've relied on private data providers. A lot of initiatives are coming online now in terms of official sector initiatives to improve in terms of the quantum of reporting of firms, to the standardization of that reporting, which is obviously always a problem. A bunch of non-standardized information is of limited use for efficient markets. So you really want that to be standardized, and also the portfolio aggregation potential with taxonomies are all areas that are being looked at. And as they come on stream, we will be looking to try and retrofit what we're doing to incorporate this. What I can say, of course, is the debate itself is shifting a lot away from emissions in particular industries or firms to forward-looking commitments. And that's quite important. As we see these proliferate, firms saying, I have a Paris alignment initiative, and that's going to mean net zero by a particular date. Of course, there's the question about the path, the credibility, the operationalization of this target. These things are all yet to be tested, and we have to really find a way to harvest these and make sure that we take these into account, because these will certainly influence financial market pricing. On the side of moving away from measurement to modeling, Katarzyna outlined a lot of challenges there. I think the biggest, if I'm to give it into sort of, and build on what she said, I think very eloquently, is the idea you have both the idea of second round effects in the form of dynamic balance sheets. How do firms react? How do banks react? How do non-bank financial intermediaries react whenever you have climate risk manifesting itself or the prospect of transition risk? Surely they don't sit with their hands. They sit on their hands in this case. They actually move forward and take action. This collective action will, of course, embed systemic risk depending on how it occurs. But also the idea of the climate. So dual materiality. It's not just that firms are subject to climate risk as direct first-order impacts, but they're also lending into the greening of the economy. And that dual materiality, I think, is something we need to try and capture a bit better as we start to adapt our models. And indeed, we are learning by doing, and each iteration we do now, we're learning a lot and trying to share as much as we can transparently with the public, with other financial or intermediaries, official sector organizations, to better understand and move the frontier forward in understanding. Now, all of this, just in a nutshell to say, Maria, the very last thing I'll put in terms of an emphasis on the final point is, of course, one of our biggest gaps is how all this collection of information will fit into policy. And I think that's where we're now doing some nascent thinking about how you will take this amassing body of empirical evidence, albeit imperfect, but nevertheless starting to be quite meaningful, and map that into available policy options and ask, where do we actually have policy remit which could be important in limiting risk, noting the prudential measures should do this, but also questions of where there are gaps in the toolkit and where might we need to take that forward. And that'll be, I think, our homework now as we move ahead this year in the next iteration and chapter of our work of the European Systemic Risk Board and the European Central Bank.
Thank you, Paul. We'll stay tuned and we'll look forward for the future research that also the ECB will conduct. And before our interview comes to an end, I would like to thank you very much, our three speakers, for agreeing to share the fascinating findings included in this joint report published by the ECB and the European Systemic Risk Board. It was a great pleasure to listen to the three of you today.